We're going to record our brilliance today. Anyway, guys, you know there is a quiz when? Today is, Wednesday. I just can't keep up. Yeah, but that's about what it is. Next time we see each other, I guess I'll have a quiz for you. Today we're going to do comprehensive problem 4-2, remember that? And maybe you did 4-1. I hope you're all ready. If not, it doesn't matter. Okay, just make sure you get through those before you quiz, obviously. Today also we have a review session before 6 p.m. Right, guys, right here. Come if you can. It'll be recorded, and I'll put the YouTube out there, and I'll put it on Moodle so you can click on it. We were talking the dean, Dan Bauer, Dan Dean. Dan actually went out and watched one of the YouTube videos, which I was spoken with him about. I was telling him that I'm not going to teach anymore. I'm just going to have students watch my YouTube videos. I'll stay home for the rest of my career. What do you think? Whatever it's amazing. Yeah, anyway, so he was telling the faculty that in the meeting yesterday. They're going to see some lessons. So, what the reason I mentioned that is, he said 24 out of 27 kids I had this summer actually accessed one of the review sessions, the one that in my summer scholarship class. 101, right? Now, granted, that was throughout the semester, right? Maybe some people who missed it because how many of you can't be here today for that? Okay, it'd be a good idea to watch. Okay, so sometime you can take 2 hours between now and Friday, right? And watch that. We're going to go through the quiz, right? But then also it'll be useful when you're getting ready for the test, perhaps. You don't know how to do a particular problem, you can go find it, huh? Okay, and then the other thing it'll be useful for is when you get ready for time. So I found people actually use these. It's the first time I tried this summer, and it's the second time. I don't particularly like the screen. Do you guys? I'm not thrilled. I'd rather just use a whiteboard, a big whiteboard, by far. Although I really use a regular blackboard too, than a whiteboard. You can see so much better. But anyway, yeah, and you could erase better. But fine, I'm a dinosaur. I don't like me being tied to this thing, and here's how big the screen is that I have to write on, which is why it looks so ridiculous up there. Well, it looked bad anyway, but at least it'd be big, right, on a board. So I apologize for all of that, but here's the good thing. If you miss class, you can watch the class. I'm trying to record all of them, put them out there. Okay? You can watch the class, so do it. If you didn't understand something in class, you can watch it again. You can go find it. If you can't make your review session, do it, right? Use it, okay? So you guys are kind of guinea pigs, but not too much, because I did this summer. And then also, I think there's some real benefit to it. I've had a number of students say they really liked it. I've had more students tell me they really don't like watching that screen. Anyway, so, okay. How would you approach comprehensive problem 4-2 then? If you can do this, you can do anything, right? You can do this, you can do anything. You can do accruals and deferrals, right? You can do financial statements. Oh, by the way, have I gone over a single problem in class where I had to do a balance sheet and income statement? No. Does that mean there won't be one on a quiz and a test and a final? Of course not. Of course they're going to be there. Can you work those problems in the book without me doing them with you? The author shows you how to do it. You can do it. I'm trying to get you to understand where the numbers come from. Copying them from the general ledger into a financial statement format, big deal. But in this problem, we'll look at it, okay? Real quick. But just because I haven't emphasized something in class doesn't mean that it's not going to be on a quiz or a test, right? Okay? I mean, you're doing the homework too, and you're reading the chapter too. Okay, cool. All right, I have total understanding. How would you approach this thing? Take a look at there on page 215. You've got all the accounts. You've got the debits and credits, right? It says they began the business January 1st, 2015, and it is now December 31st, or their year end is December 31st, but this is a trial balance on January 1st, 2016, so they've been in business for a year, right, and have done what? Probably closed the books and started over, right? And when I look at the balances in the accounts, I can see they have balances in the balance sheet accounts. You know which ones are balance sheet accounts, don't you? Assets, liabilities, and equity. Including, they have retained earnings, don't they? Right? What does that mean? It's not the first year if they already have retained earnings for one thing, right? So that's the earnings from the prior year, less any dividends from the prior year. You guys do know that beginning retained earnings is zero when you start the company. You add the net incomes for all the years that you work, right, and that you run your business. Take away all the losses, take away all the dividends, and that gives you ending retained earnings. So that $4,000 in retained earnings came from what? She was only been in business for 1 year. Then net income for that year, less any dividends they happen to pay that year, right? And that's it. Okay? And now this year we'll add this year's net income and take away this year's dividends if there are. You don't have to pay dividends every year if you don't want to. Yeah. It's on page 215. You have a different edition of the book or something?
No, it's on page.
Oh, okay. Yeah, it's early. Yeah, it's only noon. Yeah, it's early for me. Okay, anyway, so, right, so we got that $4,000 there. What's in the revenue expense accounts? I kind of lied. I said they've been running this year. No, they haven't. How do I know they haven't? We haven't recorded the activity for this year yet, have we? How do I know that? What balances in each one of the revenue expense accounts, guys? Zero. There's nothing there. That's why it's blank. There's zero. Okay? There's nothing there. You're going to create it. Okay? So they must have just closed the books. Okay? And we'll close the books at the end of this year too. Okay? So we're starting a new year. Now there aren't going to be very many transactions for the activity for the year. Do you think that would be true in even a small business? No, there'd be lots of them. Hundreds of transactions minimum for a little tiny company. Thousands for a real small company, right? Millions for a moderate-sized company. Billions for a big company. Everybody got the idea? Huge numbers of transactions. Okay. All right, anyway, so how would you approach this thing? They list all the transactions down there below, and then they list data for adjusting entries. Notice how I'm reading this problem? I'm looking at what they gave me, I'm not reading it in depth, and then I'm going down where? To required, so I know what I'm going to do before I read the problem. Then as I read the problem, I'll circle the things that I need. Does that make sense? Or maybe I'll just work it as I go once I understand what I'm going to do. Okay? Don't just start working though without reading the requirements. That doesn't make much sense. Okay? You won't get there. Set up T accounts. You guys know what T accounts are? Here's set up T account, represents the general ledger account, and put the beginning balance in it. Then prepare entries for the transactions. That means record the debit and the credit as an adjusting journal entry, right guys? You know what a journal entry is. Okay? And then post them to the T accounts. That means copy them into the T accounts as though they were being posted to the general ledger, right? Post just means copy. Okay? And then journalize and post the adjusting journal entries. Okay, so after you do all of the activity for the year, right? What do you do? Or month or quarter, however long you're doing before the financial statements. What do? You immediately look at what the balances are, right? And figure out what the balance should be and make the adjusting journal entries. So that's what all this information is for, all the adjusting journal entries. That's what we did last time, we're adjusting journal entries, right? Okay? So adjusting means what? Adjust from where it is to where you'd like it to be. Simple. Okay? All right? So we're going to create these financial statements from this. And then it says, prepare an income statement, equity statement, balance sheet. Great. Okay? And then don't worry about 5. We'll worry about cash flow statements later. Does everybody hear that? Cash flow statements, we have a full chapter on it. We'll do cash flow statements later. They like to give you little pieces of it. Read it and think about it. That's fine. But I'm not going to quiz you or test you on cash flow statements until we get to that chapter. Everybody got it? Okay? I think it was better. And then journalize and post the closing entry. We'll do that. That's after we get our financial statements done. It's the very first thing you do the next year, huh? Okay? Before you're recording the activity. And then we'll do the ratio analysis in a chapter at the end of the course, too. So no ratios, too. No cash flows, no ratios. Everybody got it? So that'll make it a little easier as we go. Well, not much, but a little bit. Okay, so let's set up T accounts, huh? What'll that look like, you guys? I like to organize it, leave lots of room in cash because there's lots of debits and credits to cash probably. Okay? So I'd like to organize it by the assets probably all in one place, seeing as they're going to go in one place on the balance sheet. Cash, accounts receivable. This won't be bad. It's no big deal. Accounts receivable is 4,000. Why am I putting them on the left? Because they're debits because they are on the left and they are assets. Yeah. Both ways, very cute. Okay. Supplies is inventory. Use the word inventory, okay, guys? So we can tell it from expense. I wish the author would do that. It's supplies inventory. Okay? And small tools. And I guess they're implying that we're going to buy some equipment. There's nothing in equipment right now. But in your chart of accounts, I guess, your general ledger, you have some equipment, huh? So it's nothing right now. Okay, accumulated depreciation on the equipment, as soon as they have no equipment, what do you bet it's nothing? What kind of account is that? Accumulated depreciation. Contra asset, yeah, so it's going to have a credit balance. It doesn't have a balance at all yet, but it will. Other assets, and those are all our assets, so when we do our balance sheet, all we're going to do is we're going to list those assets on it, aren't we? Yeah, not going to be a big deal. Okay, 9,000. Okay, and then they've got liabilities, don't they? Next one's liability. We've got accounts payable. Everybody good? I'm just writing down the balances. I bet you can do this part. 7,000. Okay. All right. And then you know what all these things are, right? Accounts payable is what? Liability, and we owe our suppliers, right? Okay. Yeah. Sure. All right. And then notes payable has no balance. But I bet we're going to borrow or they wouldn't give us the account. No problem. Wages payable, I bet we're going to have wages payable at the end. We'll probably make an adjusting journal entry. Interest payable, probably going to be the same thing. This is too easy, isn't it? Okay, all those are zero. They're going to be liabilities, so we just put them in there. Okay, and then we've got income taxes payable. So I bet apparently we're going to owe some taxes at the end of the year. All right. And then unearned revenue. What kind of account is that? Unearned revenue. It's a liability. I got paid in advance and I owe my customers goods or services. Right, guys? You guys know this stuff. See, you're developing business knowledge here. It's not accounting, really. Well, it is, I guess. Accounting is just putting stuff on the left and the right. Accounting part's easy. It's business knowledge, right? That's what we're doing here. Unearned revenue. Nothing right now, I guess. And then we've got a couple of equity accounts, don't we? We have common stock. Common stock or capital stocks. It'll be common stock, preferred stock, additional paid-in capital on it. Okay, and then we have additional paid-in capital. That's the amount that was paid in excess of par. We'll worry about that later, or excess of stated value. But the total amount, additional paid-in capital. Okay. That's the amount that was paid over the par. The total amount that was paid for the stock by the owners, that was invested by the owners, is $15,006 plus 9. That's what's going on there. And then we have retained earnings, which is another equity account. So put it over here. Okay, and retained earnings has 4,000 in it. Okay. Okay. And then we've got a whole bunch of revenue expense accounts. And of course, there's nothing in revenue expense accounts yet. Why not? Because they just closed the books, right? So we figure out there. Okay, so we got nothing in service revenue. Okay, well, we're going to use these accounts. We have nothing in depreciation expense, but I bet we're going to depreciate those assets we buy. Okay, nothing in depreciation expense. That'll be a debit, right? Revenues or credits. Everybody knows that. We have wage expense. Okay, it's got nothing in it. How fast could you do this? Really quickly, huh? Interest expense. Nothing in that. Nothing in anything, of course. Tax expense, income tax expense. Okay? And we're all set up. Get yourself set up, get yourself organized. We're ready to go. And then remaining expenses. There's no such thing as remaining expenses. They just didn't want to make a problem any longer, right? So they plug a whole bunch of stuff into remaining expenses. You actually name them what they are. You can have as many expense accounts as you want, right, guys? So it says not detailed to simplify, just to make it simple. Okay? So what we'll do is we'll write all our journal entries, then we'll copy them into these accounts, post them into these accounts. Yes, sir?
Just to be clear, you said additional paid-in capital, that's just contributed capital?
It's more contributed capital, yes. Two types of contributed capital. Common stock, well, actually, I guess there's the common stock and preferred stock, which are both stock, okay? And so that's the contribution. And then the additional paid-in capital is amount paid in over par or stated value on those. So the total amount of contributed capital is those added together. Does that make sense? And then the other type of capital is what? Equity is what? People can contribute or you can earn and retain it. Retain earnings, right? That's it. Okay, so your total equity is your contributed capital. Common stock plus paid-in capital in excess of par plus retained earnings. Everybody got it? This just makes sense. It's the way you think now, right? Okay. Where we got to get to. All right, so what we're going to do is we're going to record a bunch of entries, then we're going to post them over there, okay? And what you can either post them as you go. Each entry, you can record the entry and then put it into the T accounts, which represent the general ledger. with computers, that's what happens. As soon as you recorded it, the computer automatically puts it into the account. No big deal. Or what you can do is you can do all your journal entries and then put them into the accounts. Does that make sense? Now, before you do your adjusting entries, though, you want to post all of the transactions for the year, all the source entries, because otherwise you won't know what the balance is in the account that you're going to adjust. Does that make sense? You got to pick those up first. Okay? All right. So why don't we just do them as we go? And you guys watch me careful because I'm really bad about not recording an entry and then being screwed up. And so we'll come and say you guys are going to make too. You'll put in the debit, not the credit, and guess what? You're out of balance. Right? Your debits won't equal your credits if you don't. Put them all in there. Right? Yes, sir. Did I do something wrong?
No, I'm just clarifying that after, notes payable, that's waiting for that.
No, yeah, wages payable. That's a W. Yeah, notes payable, wages payable. Yeah, nothing in it yet, but you'll have to remind me what they are. Yeah. Okay. All right, so let's give it a shot, guys. Let's take the first entry. Borrowed $20,000 cash on July 1st, 2016. It's July 1st, which is 6 months into the year, right? So maybe what you ought to do is write down a date if they give you a date. Okay, so that's 6 months into the year. So when we do interest on that, what's it going to be? Only 6 months. Everybody agree? That's July 1st. Okay, on July 1st, then, that's what happens. Okay, and let's record the entry, huh? What'd you get? Come on, what'd you get?
$20,000.
Cash, which is an asset, so you...
Yeah.
We gotta move, guys, or we won't get through this. Okay, that's 20,000. Everything gonna be in thousands here? No, I don't think it is, actually. The interest will be weird or something. Maybe it'll be. All right, it's 10%, by the way. This is a 10% note, okay? Let me put that there. Okay, it's going to be 6 months this year, but it's a 1-year note. Does that mean the 10% that it says? Does that mean 10% for 6 months or 10% a year? A year. We always state interest rates per year unless it says per month. Okay? So if it says 1% per month, you know it's not monthly, right? Otherwise, if it says nothing, it's per year. Another little knowledge thing for business, huh? That's how we do it. Okay? So 10% means per year. So the interest on $20,000 for a full year would be what? $2,000. But it's only going to be half a year this year, so how much expense will we have this year? 1,000. This is simple, you guys, right? It's half a year. What if it's only 1 month? It'd be 2,000 per year, and you divide it by 12. You guys can do this, can't you? Let yourself think. Don't memorize anything. Just let yourself think. Okay, so it's debit, cash, and credit what, of course? Notes payable because we signed a note. All right, let's post it, guys. What do you want to do? Cash goes up by 20,000, right? Debit 20,000. Okay. Notes payable goes up by what? 20,000. Are we still in balance? Of course we are. Our debits equals our credits when we started at the bottom of the trial balance, right? It's 26,000 and you put both cases, right? And now we just added 20 of both sides. That's it, right? Okay, good. Let's do the next one. Purchased equipment for 18,000 cash on July 1st. Okay, now that's July 1st. How long are we to own this piece of equipment this year? 6 months. How much depreciation are you going to do? A whole year or 6 months? 6 months. We're intelligent people, right? Okay, you only own it for half a year. Okay, and so how much do we pay for the equipment? 18,000. Now, it would be nice if they told us how long it was going to last and what sort of depreciation method they were doing, but actually this problem is going to be easy because they're going to tell us how much to depreciate it. In real life, we'll calculate it, okay? And in a later chapter, we will calculate it. Sound good? Of course, that's what you do when you're out there, all right? Debit equipment and credit what? What do we give them? Cash. So I got an asset, gave up an asset, right, guys? Okay. Decrease equipment by 18 with a debit. Everybody agree with that? Reduce cash by 18 with a credit. This is too easy, right? So now I started with 5 in cash. I added 20. I had 25. I paid out 18. I now have 7. You guys see that right there? 5 plus 20 less 18 is 7. This is easy, isn't it? If I did a balance sheet right now, I'd put 7 on it. Okay? You can do a balance sheet anytime you want. Some people think we should do them every day. It's a real problem, because we wouldn't have all the adjusting journal entries in there. You'd have to do those every day, too. So should we do weekly statements instead of monthly? I don't know. Okay? We do all sorts of reporting on a daily basis, though. Let's try the third one. Sold 10,000 shares of stock at 50 cent market value per share okay, at the beginning of the year. So this is going to be the very first day of the year, at the beginning of the year. So I guess that was January 1st. These aren't even in order, are they? Okay, but 50-cent market value, okay? They should be really posted in order, or recorded in order. In real life, you would. 50-cent market value. Well, how much are we going to sell it for then? I guess we're selling it for cash, huh? Because it doesn't, oh, it does say for cash. 10,000 at 50 cents. We can do that, can't we? Debit cash, how much? $5,000. Now we want to credit stuff. What do we want to credit? It's stock, so guess what we'll credit? Common stock. I'm using an abbreviation there. You can too, in real life, of course. In real life, we put the account number in and the computer put down the full name. Right? You know, type in the name. But anyway, common stock. That's not going to be 5,000, is it? Let's look back at our trial balance over there, right? And they say the stock has a 10-cent par value. You see that? So this is beyond where we're at right now, but it's 10-cent par value, and I said that I want the common stock account to represent the par value and additional paid-in capital to be the amount over par. So what would 10,000 shares at 10 cents be?
1,000.
Ah, so 1,000 is the par value. Okay, we want the common stock account to represent just the par value. So it's 10 cents. See it says 10 cents there?
Yes.
Right? There's 1,000 shares at 10 cents. What is, or 10,000 shares at 10 cents? That's $1,000. So we paid 40 cents a share over par value, didn't we? So we call that additional paid-in capital or paid-in capital in excess of par. Everybody got the idea? And we'll talk about this real soon in another chapter. Okay? Everybody got the idea what this is, though? All right. So what I want is another debt credit for 4,000. What account is that going to be? 40 cents per share times 10,000 shares is 4,000, right, guys? Okay, it's the amount I paid over the par value. I paid 5, the par was 1. Okay, so additional paid-in capital. Everybody good with that? Okay, so we got 8 picks there, I guess. All right, so what we're going to do is we're going to put the 5,000 debit into cash. Everybody agree? And then we're going to put a common stock credit for 1. I guess I don't have to move down yet. And additional paid-in capital is 4. Everybody see that? Okay. So now you got 7 in common stock and you got 13 in additional paid-in capital. We going good? All right. Let's try another one. Earned 70,000 in revenues, including 14,000 on credit and the rest for cash. Okay. So what did I get? And I guess that's for the whole year. That's probably for the whole year.
You got 56,000 in cash.
Okay. How'd you get that number?
Subtract 14,000 from 70.
Yeah, 70 less 56, or less 14 is 56. What else do you want to do?
You also need to debit 14,000 on accounts receivable.
Yeah, we got 2 different assets from our customers, didn't we? Cash, and then their promise to pay us too. I'll put 1231 on these just because it's for the full year, okay? Probably would have been recorded in a whole bunch of journal entries all year long, don't you suppose? You know, every time you had a sale, record it probably. Okay, and then what do you want to credit? Revenue. What kind of revenue? Well, we're in the service business, so it's service revenue. Yeah, okay, that's it. Excellent. If we were selling them product, it'd be sales, right? Inventory, it'd be sales. And that's 70,000, isn't it? And then post that, okay? Let's put cash 56 in. Let's put accounts receivable 14 in. It's going good, isn't it? Service revenue. If you guys have been paying attention and have been working really hard, both, this is easy, isn't it? This is just not hard. You learn a lot. Just relax and do one at a time. Don't try to do the whole problem at once. It's a big problem, isn't it? Just don't do everything at once. Do one thing at a time. Boom, 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 right? And don't worry if you screw something up. I give all kinds of partial credit on the way. Okay? So you get one of the entries right, fine. You don't have to have all the totals right at the end or something. Okay, although if you do, it's nice. All right, so then they say incurred remaining expenses, whatever that means. A whole bunch of different expense accounts, right? For 2016, including 7,000 on credit and the rest paid with cash. What do you want to do with that, you guys? Debit expenses. Which ones? They call it remaining expenses, so that would really be a lot of different accounts. Everybody got the idea? How much was that? Why am I debiting? 35, thank you. Why am I debiting? Because it's expenses. That's how you increase expenses, right? Everybody knows this now. Okay, we got it made. On credit was 7,000. What's that? I'm accruing it. What is it? Accounts payable. Absolutely.
Did everybody know that? Only one person said it, but everybody knows it, right? If you're not answering every single question at this point, you need to get some help. Get to the review session, get with me, get with the ARC, get some help. If you're not staying right with me, okay? You need to have this wired. You should have it wired, okay? All right, and then the rest is paid with cash, of course, so that's a credit to cash, right? Reducing it. How much is that? Excellent. And then we need to post that. Did I post the one before that? Okay, remaining expenses 35. There we go. Debit. Accounts payable 7. Credit. Drive you crazy. Now we got 14 of accounts payable, don't we? And credit cash for 28. Boy, I hate to watch this. It's on YouTube and bouncing all over the place. Okay, we got that one done, don't we? Purchase additional small tools for $3,000 in cash. What do you want to do? And they didn't tell us what day that was. So we'll assume the end of the year. Debit small tools, which is a asset. Good. What was it, $3,000? And what did we give them? Cash. Credit, of course, it's an asset, you have less. Okay? Let's get a 3 out of here. You put in the small tools 3. And I guess small tools are a current asset, sort of, I guess. I don't know. Probably. I don't know what it is. They'd have to tell us if it's going to last for more than a year or less than a year. And then the problem, they don't tell us. Okay? So you make an assumption either way, I guess. Collected accounts receivable of $8,000. What do you want to do with that one, guys? And that's throughout the year. You got cash, didn't you? Excellent. You guys know how to do this stuff. And we said 8,000? What don't we have anymore if we collect it? The asset accounts receivable goes down, doesn't it? Excellent. Okay, so here we go. Let's post that, huh? Debit cash, credit accounts receivable. Everybody agree? Okay, we recorded that one. The next thing that happens, paid accounts payable of 11. So throughout the year, this is what we do. What don't you have anymore because you paid it? Which was a liability, and therefore it's reduced with a debit. And I heard somebody say we also don't have cash anymore. I agree with you. If we don't have the cash anymore, that's an asset. We have less. What do we do? Do you do it that fast? Of course you do. Actually faster because you're not talking. Okay, got it? And then what we're going to do is debit accounts payable, 11, and credit cash. It's really fun. Because if people at other schools who teach accounting watch this video, they think I was the worst teacher on earth. There's no way you guys can possibly understand with me going this fast. They're wrong. But no, I'm the worst teacher on earth. Not that much. That's true. You agree with that? That's what me. But you guys can keep up. You can do this, can't you? You're intelligent people. Why are Bellman grads so much in demand? We don't take an hour to do something that can be done in 10 minutes. Screw that. Huh? That makes you worth what? 6 times as much as the person who takes an hour. I like it. You know? I don't like to work. When I go to work, I work my ass off so I can go home and have my burger. Got it? That works. Yes.
So you can manage 6 times.
You won't get it. You'll just get the entry-level job instead of them. And then by the time you're 5 years in, you'll be making 4 times what they do. Just relax. You don't get 6. I'm sorry. You only get 4. If you get to be a managing partner, you get to make 10 times as much as the average person, or 20 times or something.
Because even entry pay is infinitely more valuable than company cost.
Kinda. Yeah. And you guys are only going to make 50,000 when you start. It's sad. Yeah, it's pretty good. It's pretty good. What's really funny is a lot of kids go to school and they think they're going to make 200,000 when they graduate. You got any friends like that? You know, what are they going to do? Sell drugs? You know, that's the only way you make that much money. I swear. I just don't know what they do. You know, but that's what he does. Yeah. What?
Our apartment's not making as much money as we used to.
Oh, yeah, then get good money. No. They just work all the time and they make way too much money. But they don't have any life because they work too much. At least we'd like to believe that, right? You know, if they have the money, they have to have something horrible. Yeah, no. It is an awful lot of work, though. So, but you can stop whenever you want, right? You could just double your salary and then double it again, and that'd be going out about 10 years, and then you can back off. Of course, by then you're making a couple $100,000 a year when you back off, and you keep making that. you know, and relax a little bit. It's all right. So you can do it however you want, you know, so it's your career. Now I'm lost. Okay, what were we doing? Don't distract me, you guys. Aye. Did we post H? Both sides of it? Good. All right. Purchase 10,000 of supplies on account. What did we get? Okay. The reason they're not giving you the dates on these, they really should, but the reason is that the date won't be helpful. You won't need it later, right? So purchase 10,000 of supplies. We'll debit supplies inventory, won't we? Please use the term inventory. And then credit. It's not cash. It's on account. Read carefully. Okay, who said that? Did you say that? Yeah, okay. Yeah, accounts payable. Okay, she said cash. Executive MBA. Can't read. That's terrible. Okay, anyway, so here we go. See, you can be successful and still not be able to read. You guys are going to be fine. Okay, anyway, so debit supplies inventory. Debit supplies inventory and credit accounts payable. Okay. Received a $3,000 debit on work to start January 15th. Deposit, not debit. Received $3,000 deposit on work to start January 15th. What did I receive? Cash. You got it. Excellent, guys. I say excellent when you got cash. Oh, well, anyway. And then credit what? This one's a little harder. What is that? I haven't earned it yet. I haven't done the work yet. Unearned revenue, which is a liability, and I have more, so I credit it. Excellent. Everybody told you this was going to be a hard class. It's not, is it? If you work hard. It's not. Somebody said, yes, it is. Okay. And then we declared and paid a dividend. Did I skip one? Oh, I didn't post it. Debit cash 3,000. Did I post the one before that? Credit unearned revenue. You guys aren't keeping up. Come on. Okay, credit unearned revenue 3. Okay, so then I better post supplies inventory 10, and credit. What was it? Accounts payable. Okay, make sure I do this right. By the way, one thing you could be doing if you want, which is not a bad idea. Did I screw something up still?
No, I thought it was the 3,000 in unearned revenue that you went back to the other one. Never mind.
Oh, yeah. I'm just trying to confuse it. One thing you might do, and it's not a bad idea.
Good job.
When you, what's that?
You're doing a good job.
Oh, yeah, sure. That's on tape. That you sucked up like that. It's terrible. Okay, anyway, doesn't make any difference though. Yeah.
We have proof.
Yeah, doesn't make any difference, right? When I was first teaching, I was 37 years ago. I was 29 years old, and I'd go out and drink with my students, you know, who were 21. Well, at least they had ID. I don't know. They said they were 20. Anyway, I'd go out and drink with my students, and they'd have a quiz the next day or a test the next day, and we'd be sitting there drinking. And they're kind of like, well, geez, we have a test tomorrow. I don't. And my line was always, you can buy me a drink if you want. Won't make any difference your grade either way, but feel free to buy me a drink. You know, yeah. So, anyway. All right. It's really fun to go in and they're all hungover, you know, and sitting in the front row and painting. And I hand them a big tough test and go sit down and relax. Yeah, it's great. So, yeah. Those days are over. My wife would kill me. Yeah, okay. I was single then. Okay, what you could do is you could put a check mark next to each of these and as you go. And what would that tell you? Every time I posted, I put a check mark next to it. Then I'd know which ones I posted and which one I hadn't. You really probably should do that. It's a real good idea. If you're ever training bookkeepers or something, do that, okay? Put a check mark next to it, some sort of notation that you posted it. So you keep track of what you posted and what you didn't. Does that sound good? Yeah, if I'd been doing that, when we'd know which ones hadn't been posted without having to remember. Luckily, I had all you people so you remembered. Otherwise, I'd never done it. Declared and paid a cash dividend of 10,000. What do you want to do with that? Declared means that you said you're going to do it. And then there's a date of record that you find out who owns the stock, and there's a date of payment, which is the date you paid it. They did it on the same day because it's a little tiny company. Okay? So what do you want to do? Credit cash? I heard that. I like that. How much? Excellent. And debit what? Careful, you guys. Is there such a thing as dividend expense? No. So we got the 10 cash coming out of here. It's going to go to retained earnings. I heard it. Fantastic. That's exactly right. It's going to retained earnings. Or if you want, you can use a dividends account, which is a temporary retained earnings account with a debit balance, so it's contra equity, right? You can use a dividend account if you want. And then, but that would be close to retained earnings anyway, okay? So that 10 came out of retained earnings, I already put it in there. Okay, guys? And we've done all of them, haven't we? Okay, now we're done. Now, there would be thousands of those, okay? That's just to give you an idea what they look like. There'd be thousands of entries in the account, okay? But now what we'll do is we'll figure out what the balance is in each account. Sound good? And then we'll know, then we'll look at those accounts and say, is the account right or wrong? If it's right, go ahead and do your financial statements, right? If all the accounts are right, you do your financial statements, your balance sheet and income statement. What you do is adjusting entries to take them from where they are to where you want them to be if the account's not the amount that you want it to be in the statement. Does that make sense? We're going to do all of our adjusting entries, which are mostly going to be accrual and deferral journal entries. Okay? We're going to accrue revenues that haven't been accrued yet. We're going to accrue expenses that haven't been accrued yet. We're going to accrue, we're going to defer some revenues. We're going to defer some expenses. We're going to record depreciation. Get the idea? Okay. So let's do another sheet. That's dangerous. If I do another sheet, my main one goes away, doesn't it? So let's not. Let's just extend some more. We'll put them down here. Okay. So somebody tell me what cash is right now. How much was it? 37? Oh, thank you. Somebody kept up. That's fantastic. 37 in cash. All right. And then how much is receivables? I can do that one. I can do that one. Small tools is 9 right now. Is how much 10? This one's 12. Everybody got it? We just keep going. This one's 20. Okay. What's accounts payable? It was 14. Less 11 was 3. What is that balance? What was that entry, the credit for accounts payable? Was that 16 or 10? I can't read my writing. The credit accounts payable for purchases, supplies, and accounting was 10. So what do we have, guys? 7, 14, 24, less 11. Did I hear 13 out there? Excellent. Okay, 20, 0, 3 here, 7 here. Everybody good? 13. You see what I'm doing, right? Oh, 27 for cash. That's why it got quiet out there. Okay, so I congratulated somebody for doing it early and they did it wrong. How many got 27? How many got, and only 2 people did it? How many got some other numbers? You got the 37? Come on, somebody else do it. Hurry, hurry, hurry. We got to be in balance. Move, guys. How much was it? 27 or 37? 27. 27 here. 327. 137. Another 27? Okay. We'll find out when we look at the balance sheet. We'll be out of balance, right? Got the wrong number? Okay. Or you could add up all the debit balances and subtract all the credit balances and make sure it's 0. Ever hear of zeroing the accounts? That's all that is, no kidding. It's making sure the debit's equal to credit. Okay, so here we go. We're going to do adjusting journal entries. Supplies of 4,000 and small tools of 8,000 were counted, and they're going to debit remaining expenses for what was used up. Okay, really you would debit small tool expense and supplies expense, wouldn't you? Right, everybody agree with that? That's what you really debit, but they want to put it in remaining expenses to make life simple. Okay, so these are all going to be at December 31st. These are the adjusting journal entries, right? I want to adjust the account from where it is to where I want it to be. Okay, so let's see. Let's look at supplies. What do we have in supplies inventory? 12. What do we want it to be, you guys? Come on, hang in there. 4. Gee, the account has 12 in it. I want it to be 4. What do you want to do to it? Credit it for 8. These are these adjusting journal entries we did last time, aren't they? I'm going to credit that for 8. Credit supplies inventory. Could you do this on a quiz or a test? Sure, big deal. What else do we know? We counted the small tools, there's 8,000. What do we have in small tools right now? 9. I want it to be 8. How many don't I have anymore? 1. Does everybody agree with that? Used up one. If you used up one, you'll have to credit supply, or what are these small tools? Okay, so what would I do then? If I used them up, what do they become? A cost of generating my revenues, an expense. And I'd really call it supplies expense, small tool expense, don't you suppose? They want us to call them remaining expense, fine, we'll do it. Okay? Just to make the problem simpler, they think. Okay, or less complicated to write anyway. Depreciation is 2016. So what we're saying is what? This piece of equipment that we have down here, this piece of equipment that cost us 18, they used up $2,000 of it, 1/9. It must have a 9-year life, but they only had it for half a year, didn't they? So I guess it's a 4.5-year life, or if it's a straight line, we'll worry about that later. Okay, so anyway, they used up 2,000 of it. So what do you want to be 2,000? Which account would you like to be 2,000? Accumulated depreciation now ought to have 2,000 in it, so let's put 2 in there. What do you bet? Accumulated depreciation gets a credit of 2,000. Don't you think? Everybody like that? Okay, and then what are you going to debit? I used it up, and it became a depreciation expense, an expense to generate revenues. I'm using up that equipment, generating revenue. So it'd be debit depreciation expense, wouldn't it? So 2,000 goes there. Everybody got it? And I've posted those. I've posted all of them, haven't I? Everybody got it? No big deal. What kind of account is accumulated depreciation? Contra asset. Where are you going to show equipment? On your balance sheet as an asset. That 18 is going to go on the balance sheet as an asset. Everybody agree? And then you're going to subtract from it 2, accumulate, you're going to say less accumulated depreciation 2. What's 18 less 2? It's 16. That's the net remaining book value of the asset. Everybody good? Are they carrying back? Okay, good. All right, don't get tired on me. All right, so let's see. Interest accrued on the notes payable to be computed. We already computed it, didn't we? What was the note payable? Way back at the beginning there? The note payable was 10,000, wasn't it? Whoops, 20,000. I'm lying. Okay, it was 20,000 is the note payable. What was the interest rate? 10%, right? So we said for a year it would be $2,000, huh? But we only had the note from July 1st to December 31st, so how much interest are we going to accrue? 1,000. It's going to be 6/12. 6 months over 12 is the way you do it. Sound good? 1.5, obviously. Okay, so what's that going to be? $1,000. Does everybody see what I just did? This is the note payable, and this is the interest for this year. We haven't paid it. We're not going to pay it until the note's due at the end of the year, right? At the end of the full year. So what we're going to do is do what? Accrue it, right? We're going to accrue this interest. So time has gone by, and I have interest, right? So what am I going to do? I'm using this money to generate revenue, so the cost of the money is interest, expense, got it. And it's a debit, of course, because you always debit expenses to increase them, don't you? Excellent. Okay, and what do we credit for 1,000? I haven't paid it, and it's interest. Come on, I owe it. Yes. Excellent. Okay. Just keep working, you guys. This is going to get so it's boom, boom, boom. Okay? That's where you want to be. All right. Interest expense is 1,000, so we find interest expense down here, and we put 1,000 in. Everybody good? And interest payable gets credited for 1,000. Where's interest payable? Way on the right. Wages. Oh, down here. Whoop, that's interest expense. There it is. Up there. Okay. Got it. Okay? Everybody good? We're staying in balance. All right? Every time we make those journal entries, we record them. Debits and credits both. Wages earned since December 24th payable, but not yet paid. They earned it, and they are generating revenues for us. We're trying to. These are our employees. So what is this to us? An expense, wages expense, and we haven't paid it yet, so we owe it, so it's wages payable. Yeah. Okay, so it's increased the expense with a what? Debit, of course, right? How much? Excellent. And credit what? Wages payable. Guys got it. Okay. All right, so let's put in the wages expense, 3. And let's put in the wages payable, 3. Okay, we're getting there. And then it says income tax expense was $4,000 payable in 2017. Okay, so tax expense, what they did was they figured out what their taxable income was. All their revenues less all their expenses is their net income before tax. and then you do a tax return and figure out your taxes, okay? Or just estimate it based upon the tax dollars. Anyway, they haven't paid it yet, guys. So, is taxes a cost of doing business? If you don't pay your taxes, the government closes your business, so yes, okay? Also, it's a benefit to society, right? Okay, so the cost of the business, benefit to society, it's an expense, okay? All right? So what do we want to call it, seeing as it's for taxes? Yeah, it'd really be income tax expense, whatever the account name was they used. I guess I abbreviated it on mine. All right, how much was it for? And credit what? Income tax payable, you got it. Everybody good? If I paid it, it'd be cash, of course, but I didn't pay it. So income tax expense is for debit, and income taxes payable is for credit. All right, now if we assume we got everything right here, note payable, interest payable, tax payable. All right, if we did everything right here, what can we do now? Prepare financial statements. That's it, guys. That's it. I'm not kidding. Let's take a look at where we're at. I know what the balance is in cash, 27. I know what receivables is. I know what equipment is. I know what supplies inventory is. I know what accumulated depreciation is. I know what small tools is. I know what other assets is. Can I do my balance sheet, the asset part? Sure, big deal. Okay, accounts payable, notes payable, wages payable, interest payable. Let's see, taxes payable, unearned revenue. They could have had us earn some of that unearned revenue by the end of the year too, couldn't they? What if I earned 2,000? Debit what? Unearned revenue. Credit what? Service revenue. You could do it, couldn't you? Okay. I got common stock. I've got additional paid-in capital. Okay. I got service revenue. I have depreciation expense. I have wages expense. We'll come back to retained earnings. I've got interest expense. I've got tax expense. I've got remaining expense. Now, retained earnings has a 6,000 debit balance. That looks ridiculous. It's a deficit, retained earnings. I haven't put in this year's net income yet, have I? Well, I'll take all my revenues less my expenses. I'll get this year's net income and I'll add it to retained earnings, right? Here's my beginning, 4,000. Here's my dividends, and I'm going to take and add net income in here. I'm going to add net income, and that will give me my ending. My closing entry is going to do that for me, right? But you have to add it for your balance sheet, or your balance sheet won't balance. That's because some of your journal entries are debit expense and credit assets and liabilities. Well, that's not in retained earnings. It's not in the balance sheet, is it? It's in expenses. Some of your entries are debit accounts receivable, or debit unearned revenue, and credit sales, aren't they? Service revenue in this case. They are, aren't they? Those aren't in the balance sheet either. They're in the income statement, and they're not in retained earnings yet. So when you do your statement, you have to add it. Then when you close all the revenue and expenses, you take the balances in the revenue and expenses and do what? Add them to retained earnings. The difference to retained earnings and now the balance sheet balances to start a new year. Okay? Question? Did I not post it? Oh, yes. Who let me get away with that? Did I post the other side? We would have been out of balance. Thank you. Okay. She wanted to redeem herself. Okay, so 35 plus 9 is 44. What would have happened if we didn't pick that up? Thank you very much. What would happen if you don't pick that up? We're out of balance by 9. And then you go back and look at your entries and find out what you missed. What happens if you post a debit as a credit? Or vice versa. Credit as a debit. You're off by double that amount. Everybody good? All right, let's look real quick. I know we only have a couple minutes, 1 minute maybe. Let's look at, if I can get it to call up real fast, the answer. Might be a faster way to get it. It's not the fast way to do it because I don't have them out there. Oh, shoot. Tell you what, be sure and look at, what do we have going on? You can stick around all the in between the 10 minutes. Be sure and look at the solution for this, and also do 4-1, right? Call it 4-1. Look at the balance sheet, look at the income statement, look at how they're formulated, the headings, right? Company name should be at the top of the statement. The name of the state should be there, balance sheet, income statement, statement. Statement cash flows later, but equity statement in this case. And then, listen to this carefully. On the balance sheet, you just state a specific date. The author says, as of a date, nobody ever says that stuff. You just say the date, December 31st, whatever it is. And then on all the other statements, income statement, equity statement, cash flow statement, you say for a year ended, because you start with the beginning of the year with nothing, and then work to the end of the year. Does that make sense? Okay? So be sure and get that right. With the current assets, you did that on the first quiz, what was current and what's not, right? With the current liabilities, as a group with current liabilities, and then the non-current separately, and you should, right? Make sure you're actually keeping the liabilities separately, right? Make sure your income statement ties in. So go through that process, okay? And we'll talk about it in the review if you make it. If you don't make it, you can look at it on tape, I guess. What's that? 4 o'clock, right here. See you guys.